All right, welcome to the Real Estate Investment Club at Intel. Today we don't have very many announcements, only that if you are new to looking at the SharePoint, which we've recently put up, please come to this address and check it out. I'll drop that in the chat box as soon as our speakers start and I'm not presenting. Also, check out our upcoming meetings. We have a variety of people that are coming up, a lot of really good speakers, several that are going to be focused on particular areas. So we've got real estate agents in the Folsom and the Bay Area, as well as the Portland areas scheduled. We're still looking for somebody in the Chandler area. So if you know of somebody who'd be willing to come in and present, let me know about them. We've also put up the video recording sites, and I know a lot of people contact me and say they've listened to the recordings that are here. We only have 21 of them up currently. This is about half of our current recordings, and we're working to get these recordings published. But you can come here and look at all the different topics that we've had before, such as virtual assistants, how to evaluate a commercial office park, the ambassador from the CDC to the WHO who invests in real estate, how to find and buy single-family homes. Lots of good topics here. And if you're not speaking, make sure that you are on mute, please. And as soon as I'm done speaking, I'll go around and mute people. Or maybe I'll start now. Just to finish up the announcements really quickly, make sure you check out our Yammer list, as well as the Community Recommendations Board, which is a new section. I put together this area by adding a wiki module to SharePoint, and I believe that everybody has right access to this page. So let me know if you don't have right access to this page, and if you have people that you would like to recommend, go ahead and put them here. With that, I am going to put people on mute, and I'll turn it over to the speakers. Yes.
Hey, Daniel. Ming, could you please mute?
I would love to. I just have to search and find the person who's doing that.
Oh, it's just trying to help there while you were getting set up. Ming, I think, was the one that's got their mute that needs to happen.
Okay. Perfect. Yep. Okay. Sorry about that, folks. All right. And with that, we have two speakers who are specialists in their fields. They work in 1031 exchanges and also in financial advisory services, including talking about Delaware Statutory Trusts. I'm going to turn the presentation over to Corey and Melissa.
Great. Thank you so much for having us this morning, Daniel. Corey, were you going to go ahead and speak briefly first and then finish up at the end? Was that our plan?
Yeah. I'll introduce myself and then turn it over to you, as I know you'll be spending most of the time diving into the details of 1031 exchanges. So anyways, first of all, thank you again. My name is Corey Thomas. I'm a founder at Sound Foundation Wealth Advisors, just right in the Portland, Oregon area. And it is awesome being on the investment club at Intel. I've actually been working with Intel employees on their investments for a lot of years. Typically, our focus is on the Fidelity 401k, where we offer professional investment management and financial planning. But today, we're going to cover, obviously, a topic that comes up in that investment conversation, which is in regards to real estate. And as we dive into 1031 exchanges, where my role is we actually offer and educate folks on a real estate solution called the Delaware Statutory Trust. And what that is essentially a real estate fund that is eligible to be 1031 exchanged into, even out of a hard property, like a rental property. And these funds are usually comprised of institutional grade real estate that includes storage units, long-term care centers, Amazon warehouses, multifamily apartment complexes, and many more. So we'll have a brief time in a little bit where I'll dive into a little more details on that with Melissa. But that's essentially what I was going to speak a little bit about today. But with that, I'll turn it over to Melissa, and she can dive into the 1031 exchange details.
I'm just listening to this real estate investment club thing. It's on Fridays at noon. I never.
And you're not muted. We can hear you talking. Good afternoon, everyone. Thank you for having Corey and I. Now I need to just find where's my PowerPoint? Hold on here. It should be open, so just a second. Okay, there it is. I'm sorry, it just didn't appear to be correct because it's at the end. Okay, there we go. This is the one I want. Oh my goodness. Oh, computer. See, we knew we would have some kind of challenge, right? This is why we practiced. There we go. Okay, share. Yes, there we go. We're going to share from the beginning. And then so, yes, I know I'm sharing. There we go. Oops. Backwards. Thanks again for having us. So my name is Melissa Ormston, and I am with First American. And just letting you know, someone's still not muted, as we can hear. Anyway, so I'll just dive right in. And Daniel and I had talked the other day. You guys can certainly put in chat questions, and Daniel will read your questions, or feel free to ask questions as you have them. I have no problem with that. My information is here and on the last page of the slide, and you're welcome to reach out through there or through Daniel to get a copy of this presentation if you want information, if you have additional questions on the 1031 exchanges. So I've been in the real estate market for over 18 years. I was actually a real estate broker licensed in the Washington and Oregon area prior to joining First American Exchange. And so I've got, I was 14 years with that, 4 years with this. So I've been 18 years in the business. So who is First American Exchange? Well, we're a national qualified intermediary. We are a part of the First American Financial Services family. So we are a subsidiary of a large corporation, $6 billion plus, and we are actually a national provider of intermediary services. So we are licensed to operate anywhere in the U.S. as far as 1031 exchange services. And just so you understand, if you ever look at doing a 1031 exchange, you do have to hire a qualified intermediary to do that. You are not able to sorry, the little text messages come up and it's like, oh, hi. We do exchanges nationally, and you do have to hire someone to do a 1031 exchange. You can't just do it on your own. So, requirements for creating an exchange. So you need to sell then buy, but you can't just do it. You actually have to do an exchange like we talked about. So you have to engage the services of a qualified intermediary prior to you closing on the sale of what we call your relinquished property. So your relinquished property is the property you're selling. You have 45 days to either identify, close on or identify a replacement property. You do have 180 days to complete your exchange, and the timing is from the point of closing. And I'll get into a little more detail on timing in a little bit. Your money. So you do need to invest an equal or greater in value for your replacement property to what you're selling. And all of your cash needs to go back into the replacement property. And then the difference is offset with a new loan, additional cash, or a combination of. Vesting is also an important aspect, and what we're really trying to determine is the same taxpayer role. So it's not necessarily how you're holding title, but who is actually the taxpayer within that holding. So that's not always clear. Sometimes it's a little bit like an Easter egg hunt trying to figure out who my taxpayer is. And then like kind. So it does need to be real estate to real estate, and it needs to be used for income or investment purposes. So your primary home is not, so you can't sell an investment property and then buy a primary home. It needs to be investment to investment. So like kind, there's a lot of confusion on this aspect. We find is that a lot of times people believe that if they're selling like bare land, they can only buy bare land. And again, at a very basic level, you want to look at it and think of it as real estate to real estate for investment purposes. That is the best way to think about what like kind is. So I can sell any type of property and buy any type of property. So I could buy residential and buy commercial. I could sell commercial, buy industrial, bare land. So I'm not limited to a specific property type. So you really have basically sky's the limit as far as doing that, especially as you're trying to increase and expand your real estate holdings. A lot of times people start with single family residence. It's not unusual for people to, rather than sell their current home that they've been living in, turn that into a rental as their first rental and then move into a new primary home. And then just kind of build from there. So why do you want to do a 1031 exchange? Well, there's a variety of reasons, and these are just a few of them that really play a lot into why you want to do an exchange. So one of the major benefits you have in investment property is you get to depreciate the improvements of the real estate. Now, we don't depreciate land. Land only appreciates. But you do get to depreciate the improvements on said land, and that's a great tax benefit that's available to you. Now, you might want to make a little notation for yourself. All residential, including multifamily, is straight line depreciated at 27.5 years, and commercial is 39 years. And again, this is a great benefit that you receive each year as a tax write-off. Now, if you have held that property for a significant amount of time, you may be either almost fully depreciated on that improvement on that asset, or you could be fully depreciated. And I have somebody I'm doing an exchange for the end of this year that literally it's been an investment property for 100 years. So they have been out of depreciation for a significant amount of time. And that's a huge thing to think about. The other thing a lot of people don't think about is maybe my property right now is worth, $500 or $1 million, depending on my market. And I bought it for significantly less when I bought it even years ago or 5 years ago or 20 years ago. I'm depreciating the value of the asset when I bought it. Can you define depreciation? Sure. So let's say I have a property that I just bought for $500,000, and the land value we give $200,000 in my random example, and my structure is worth $300,000. I get to straight line depreciate that. Let's go with its residential, 27.5 years. It depends on the type of property for depreciation. So again, it's 27.5 years for all residential, including multifamily, and it's 39 years for commercial properties, okay? And so what I can do is, if you go beyond 27.5 years, you've run out of depreciation and you lose that tax benefit that you have available to you. So that's why you may want to look at, if I've held a property for a significant amount of time, I'm either depreciating a very low value because I'm depreciating the value of the property at the time of acquisition, not current value, or I'm fully depreciated and I'm losing that tax benefit that's available to me. So if I sell my property, I get to restart that depreciation schedule. So I restart over to the new price point, and I get to restart over at 27.5 years or 39 years, depending on if it's residential or commercial. And again, it's only the improvement. So if I just have bare land, I would have no depreciation. So again, do not depreciate the land. So when they look at my real estate asset, and your tax advisor is probably doing this for you already, and you don't even realize that, they determine a specific value percentage of your real estate is land, and the other portion is the improvements. And that's the portion that gets to be a write-off each year as a tax benefit. So in some places, my land values are going to be a higher percentage of my overall real estate value. And in other places, my land value is going to be significantly less of my overall value. So places like Texas, where my land values are so much less expensive, I'm going to have almost 90% of my overall value is going to be in the improvements, versus in California, I'm going to be almost, like 50% land and 50% of the structure. So I don't have as much value that I get to depreciate in that case. Daniel, I missed that last question. I didn't get a chance to read it before it disappeared on me.
Sure. The question was, can one only depreciate improvements one makes or all existing improvements on the property? And we have one other just before that as well.
Okay, and what was the one before that? Did I miss that one too?
Yes, the one before that is If all depreciation is 27 and a half years, how would a property exceed that in depreciation length?
And I did answer that. You're done.
Okay.
You know, you're fully depreciated and you don't have that tax benefit anymore once you've exceeded your 27 and a half or 39 years. So like I said, the people that owns the property for 100 years have been out of depreciation for 75 years, basically what it amounted to, because it was actually a house that they ran the business out of. With the improvements, yes, if I make capital improvements to the structure, I can look at a potential adjustment. Exactly. So areas of California, my land value, significant value, my overall value. Therefore, how much I get. Your basis is established for your depreciation schedule at the time of acquisition. So when I buy the property, if, again, my example, I buy it for 500,000, we give the land value 200, I'm going to depreciate 300,000 over a 27 and a half year schedule, straight line. And that is a tax benefit I receive each year. That's different than the 1031 exchange. What we're talking about is when I want to sell my real estate assets and I want to roll it into a new real estate asset, I would do a 1031 exchange. There are some limitations as far as how frequently and how many exchanges I can do, but I don't think we need to worry about it too much. You'd have to be doing a significant amount of moving of properties for that to become a problem for you. So just understand depreciation is a big benefit as an investor in real estate that you have available as a tax benefit. And keep in mind, you're either depreciating a lower, actually, the questions are getting hard, Daniel, to try to keep up.
No problem. So we can either take them all at the end, or if you want, I can interrupt you and read them at the appropriate times. Just let me know what you'd like me to do.
Yeah, I like being able to read them and answer, but I think it's getting a little bit tough because
Yeah.
I'm going to get stuck on depreciation and not get anywhere else, honestly. And I want you, let's wait on the questions for a moment, okay? Definitely text them and then we'll see what we can do with those questions. But just understand the tax depreciation schedule starts from the point of ownership. If I'm making capital improvements, I can, look at doing an adjusted basis for those capital improvements. Repairs do not count. We're talking about capital improvements, like I make it bigger, things like that, not I need a new roof. The benefit of doing a 1031 exchange is when I roll it into a new property, I'm going to establish a new basis at the value of that real estate asset. I restart my depreciation schedule over at the new value versus what I paid for my property 10, 15, 20 years ago. So that is a huge benefit to doing an exchange, is restarting my depreciation schedule at a higher price point. Okay. No, it is not capped. Co-owner problems. So a lot of times we get into business with people, it's kind of like a bad marriage, right? We get in with good intentions and things don't stay that way, and we want to move along and don't want to be in business together anymore. So we want to sell those properties. Well, again, we don't want to lose out on taxes because I don't want to be in business with somebody anymore. So that could be a reason why someone wants to do it. How about tired of the 4 T's? So I have found that a good portion of my real estate investors self-manage. So you get tired of the tenants, toilets, trash, and taxes. I like to add a little R, especially because most of you are living on the West Coast. Arizona people, you have it a little bit easier because they're not quite as, you're going to have enough income to use it. I don't know if it passes over as a forward write-off or not. But what's nice is you get to use that depreciation schedule to help offset the income that you got on the property. So think of it that way. The other thing I like to think about is regulations. So Washington, Oregon, and California seem to, I'm not sure if it rolls over. That would be a question for an accountant.
Hey, Melissa, I'd be glad to read the questions for you and interrupt. You don't need to keep your eye on the questions. I'm trying to answer some of them as you give your presentation.
How's that?
Yeah, I'm just trying to answer some of them as you do your presentation. And
I appreciate it because I am getting way too distracted by them. So sorry, guys. Yep. Okay, regulations. Washington and Oregon, California are very landlord non-friendly, I guess, if you will. They really are skewed towards the tenant. So there are cases where people are just tired of that regulation and want to get out of owning their real estate in those states into more of a landlord-friendly state. Also, our return on investment, we tend to be very expensive on the West Coast, and you can't really get the best return on your investment for costs associated with the real estate in relationship to what you can get as a return or rent on that property. So that would be another reason to relocate to somewhere that's a little more cost effective, you get a better return, and a little more landlord friendly. I also found that a lot of our investors are, aging, they're retiring, and they are wanting to relocate to where they want to retire, and they're going to relocate those rentals closer to them so they can continue to self-manage those. Another big key thing to keep in mind with doing a 1031 exchange is leveraging those tax deferral benefits. Okay, the tax deferral benefits is kind of one of those things where I kind of joke about, we were all told, or most of us, when you're young, put in your 401k because the time benefit of money as you're younger, that you get that huge benefit of the time. It's the same thing with this, just different. If I don't have to pay $50, $100, $200, $300,000 in capital gains and income taxes on the sale of my property, that allows me to have more money that I get to invest in real estate for myself, where I'm making better return on my investment rather than paying the taxes and having less money to invest. So the deferral, the time benefit of that is amazing as far as being able to use that additional funds to make more money for myself over a long period of time. And the idea too is hopefully with my investments, I'll continue to improve my cash flow. Understand too, just like I'm not limited in property type to a specific property type, I'm also not limited to one-to-one when doing a 1031 exchange. I can either diversify or consolidate. So I am allowed to sell one property. So especially, let's say I'm selling in California and my current properties were $2 million, and I decide I want to move to Indiana or Texas or Florida. I'm not necessarily going to want to buy a single property for $2 million unless I'm looking and going to, commercial or multifamily potentially. So I can actually buy several properties instead of just one for one. So I can buy several properties, or the reverse is true. If I want to consolidate and sell several, maybe I have like 3 or 4 single family homes and I want to sell those and roll them into a mid-sized apartment complex, I can do that. Just keep in mind, I need to be very strategic when I'm looking at doing either one of these things because of the limitation of time to complete a 1031 exchange. So these are reasons why most people are looking at as exchanges. Restart my depreciation schedule. I don't want to be in business with you. I'm tired of handling real estate. I want to relocate. I'm going to improve my cash flow, or I want to diversify or consolidate. So there are deadlines that we have to keep really forefront as far as when we're looking at a 1031 exchange. And all of these time deadlines, we close on the relinquished property. So it doesn't have to do with when I get under contract or engage our services. It has to do with when I close on a property. So from the point of closing on my relinquished property, replacement, or identify what is I'm going to buy. And then I do need to complete my exchange by 180 days of when I sold the property, or we're getting into this area where the date is of my 180 days may go beyond when taxes are due next year. I either have to complete my exchange before the taxes are due in April, or I have to file for an extension to go beyond that into my full 180 days. I don't get more time, I just get my full 80, but I have to file an extension on my exchange to exceed beyond when taxes are due. So we're kind of getting into that time of year when people will have to start thinking about their 180 days going beyond the April deadline. So just like anything in a real estate transaction, everything happens the day after something happens. So the same with an exchange. I close today. Day one is tomorrow. I have 45 days again to close or identify, and then 180 days to close. If my 180th day hits on a weekend or holiday, I am required to close the business day before. There are no extensions. So there was, and I get this question frequently, there was for a short period of time earlier this year, the IRS did grant an extension on 1031 exchanges due to COVID-19 because it was very difficult because of all of the sheltering in place and things for people to find a replacement property. So depending on where people were in their exchange, from April 1st, if I either was needing to identify or close within my 180 days, I actually was granted additional time all the way to July 15th. It was only basically a benefit for people about a 2-month period. I went from April through the end of May, June 1st, my 45 days hit back at July 15th. So they just tied everything to when they had the extension for our 2019 taxes due. They have been very clear that they have no intention of issuing another extension on 1031 exchanges, despite lobbying efforts on our part and others. They're pretty much saying no. There have been a few people who have tried with their tax advisors to get extensions based on they do issue for federally declared disaster areas, and the IRS came back a few weeks ago, threw the hammer down and said, no, not going to happen. You don't get to use that excuse as an extension either. Now in California, you guys get extensions almost every year because of the fires. And so you do have it. In Washington and Oregon, they have yet to issue an extension due to the fires that we've been experiencing here. But we do expect that there probably will be some extensions, and that will just, again, depend on where you're at in your exchange process, if you actually qualify for an extension due to the federally declared disaster due to the fires. But pretty much plan on it being that 45 and 180 days. Now, identification. The important thing to understand is that the two most common identification rules is the 3-property rule and the 200% rule. Okay, the 3-property rule is the most commonly used rule and the rule that most of you have probably even heard of. It's exactly like it sounds. I can list up to 3 properties regardless of value. I'm not required under contract to list it, nor am I required to thing to complete my exchange. But I want you to understand the importance of the identification rule. Whatever I identify on day 45, and I don't do this until day 45, by the way. Day 45, whatever I list, that is what I'm limited to. There are no substitutions after day 45. So the way I like to help people with this, because 45 days is pretty fast, and our markets that we're seeing are very competitive, and it's very challenging to find replacement properties because of the competitive nature and the lack of inventory, is you want to use the time while you're pending as like free time on the clock. So use that time to your advantage. And by the way, there's nothing that says you can't get a replacement property under contract before you get your relinquished property under contract. You just want to simply make sure you're closing on the relinquished first and then the replacement. So if you can get a contingent offer, or maybe you're looking at a new construction with a builder that's going to be outside the 180 days, I would absolutely get that under contract and then time my sale of my current property to fit within the 45 and the 180 as far as buying new construction. Be very careful with new construction because there have been a lot of delays. I have one client that's barely making it under the wire, closing at day 179 on his new construction, and only happened because he had to beat up on the contractor to shorten that time by almost a month, which was supposed to close this spring. So be very, very careful right now due to COVID-19. There's also, my understanding, some challenges with delivery of materials for construction. And then the other most commonly used rule is the 200% rule. Now, this one only works if you are looking at buying multiple properties that are less expensive than the property you are currently selling. Okay, what this means is I'm not limited to 3 properties, so it's not limited by the number of properties. It's limited by the combined value of those properties. So it's unlimited number, but I cannot exceed twice the value of what I sold. So if I sell a $2 million property, I am able to list up to $4 million combined value of those properties on my ID form. Now, do understand the idea behind both of these rules is I'm going to list what I currently have under contract, And then I have the option of listing backup properties in case something happens to the one I already intend on buying. And if I close before day 45, I don't have to take this additional step. It's considered automatically identified at that point. Now, why do we want to exchange? Okay, you want to exchange because of taxes. Now, short-term capital gains tax is 1 year or less, and that is taxed as ordinary income. Long-term is at 1 year and a day. Okay, if you have an income below 434,550 as an individual or 488,850 as a married couple, you are looking at 15% capital gains tax rate. And if you are above that income level, it goes to 20%. There's also another tax, which is called the unearned income tax, formerly known as the Medicaid tax. If you have gross income over 200 as an individual or 250 as a couple, you have this additional 3.8% unearned income tax. Now that does include the gain from the sale of the property. So if the gain you realize on that sale of property puts you over this income level, you will be subject to that additional tax. And then remember we talked about depreciation, right? So that's a tax benefit that you get each year holding that real estate and property. If you do not do an exchange and you simply sell the property, you will have to recapture or repay 25% of that depreciation you have written off over the duration of your ownership. So if I have $100,000 in depreciation I've taken over the time that I've owned the property as an investment property, that tax liability by itself is 25%. So understand the depreciation recapture is a higher tax rate than it is if I were to do just the capital gains tax. So let's look at an example. I actually like my personal one better. So I had a gal come in to me a few years ago, and she had an apartment complex that she had owned for 20 years. She'd paid $750,000 for it. She had an offer on the table for $1.5 million. She wanted to have an idea if she didn't do an exchange, what her tax liability was. So her income level is such that she would be at 20% capital gains tax rate, which then means that she would actually have that additional 3.8% unearned income tax. Plus she was in Oregon, so Oregon income tax 9%. Those of you in California, you would also have income tax on the sale. And by the way, that has to do with either where you are located or the investment property is located. So if you're located in a state that doesn't have income tax, but the property you are selling is located in a state with income tax, the property would be subject to income tax as well. And some states do have capital gains tax rates as well. So each state's a little bit different. But in this case, it was Oregon, so we had the 9% income tax. And then she had 20 years of depreciation recapture at 25%. Now understand, remember, I said she was fully depreciated at 27 and a half years because it's multifamily. So she's almost fully depreciated on that asset. So on her $750,000 in gain, her tax liability, if she did not do an exchange, would run somewhere in the neighborhood between $300,000 and $400,000. Now, if you throw in the fact that she still had the loan on the property, she was going to have closing costs. And then if she took care of all of her taxes, after she was all said and done on her $1.5 million sale, she was going to be looking at a couple $100,000 in taxes. So it can, gain money to walk away with. And then what is she going to do with it? So that is the dilemma you're faced with in not doing an exchange is you're going to lose a significant amount of what you earned on that property to taxes if you don't do an exchange. Now, here's another problem we run into. So in this particular example, the client bought the property for $200,000. They're now selling the property for $800,000, but over time they've refinanced the property and stripped equity out. Now they're walking away with $160,000, but you know what? It's not taking into account closing costs. So let's throw another $60,000 out, and now she has $100,000. Guess what? My problem is my taxes are nearly $200,000, and I'm only walking away with $100,000. That, I don't know about you, but I'm not walking around with an extra $100,000 I want to throw at taxes. So my problem is a lot of times people think they only have to pay taxes on what they walk away with. Keep in mind your taxes are based on your gain. So in this example, they have $600,000 in gain that they are actually looking at taxes, not $160,000 that was their equity after everything was said and done. So be very, very careful when people strip out equity. That can be the case. Here's another example where it might still make sense to do an exchange. Just because you don't have any gain doesn't mean you don't have any tax liability. So depending on how long you've owned that property, you could still have depreciation recapture. So I had a client that had owned a property for 10 years and was basically walking away break even. They had 10 years of depreciation recapture, was about $40,000 on taxes on a property he broke even on. So even though someone might not have any gain, it may still make sense for them to do an exchange depending on how long they've held the asset. So how do you defer the taxes and what are the guidelines on moving forward? So the purpose, again, this is all about deferring the payment on the capital gains. And keep in mind, this is a deferral. So some people would be like, well, why not pay it, right? Well, it's called, the ultimate exit strategy is to die. So basically, like our lady who had her property with $750,000 in gain, and then we would have, instead of her having $300,000 or $400,000 in taxes, you would have it be that it would go to a step up in basis at passing to the value of the property at that time. Gain is eliminated and it goes to an estate tax. And by the way, gifting your property does not necessarily get you away from capital gains. Be very careful about that idea. Because gifting taxes and capital gains taxes are two different things. So be extremely careful about that. I have a lot of people run into that problem that they want to gift, and that doesn't necessarily eliminate your responsibility as far as capital gains tax. Also, there is no guideline to if I own it for less time or more time that will get me away from capital gains. If I have capital gains, if I have gain, I have taxes. So and by the way, income level is not going to do it for you either, because you'd have to be basically below the poverty line, including the gain you realize on the sale of the property, to not owe taxes. In capital gains situation, it's extremely hard to get out of owing the taxes unless you do an exchange or it's passed on through the estate after you pass away. So be very, very careful about thinking that your income level, holding, or something like that is going to get you around paying the capital gains tax. Okay, so properties that can be exchanged, any real property that is an investment. Okay, so and that isn't a flip, by the way. This has to be something that I'm holding and intending to hold as an investment property, either as a rental or for use in business or trade, or raw land for a period of time for the increased value of the raw land. And then there are two parts: the transfer of the relinquished and the acquisition of the replacement. So I have to both sell and purchase real estate. Okay, to be a fully tax deferred exchange, yes.
Oh, I was going to interrupt with one question that we have here.
Okay.
The question is, can you inhabit the property for 2 years and transition it back to being your primary residence to avoid?
Nope.
Okay.
Okay, there's two answers to that question. If it was your primary home first, before you converted it to a primary home, then yes, you could move back into the home for 2 years and qualify under the 121 tax code, which is our primary home. You have to live in it for 2 of the last 5 years. It's $250 as an individual exclusion and $500 as a couple, and eliminates gain. It does not eliminate depreciation recapture. That does not ever get eliminated, so that would still be owed. I cannot just move into my investment property. I cannot just move into my investment property that I've held as an investment property for 2 years and get a full exclusion. Prior to 2009, I could do that, but the IRS realized they had a loophole and they changed the tax code. So as an investment property that I want to convert to a primary home, it has to do with a proration of years of ownership to qualified use. So an exit strategy, if you have minimal investment properties, and this makes sense, is that you can exchange into a new investment property. You hold it as an investment property for a minimum of 24 months, and then I can move into it, and I need to hold it as an investment for at least 3 years. And because I have to hold it for a minimum of 5 years. And so hold on just a second, sorry. Shared office space. There we go. There we go. Okay, so most of us work from home, right? So we get that shared space. Anyway, if I exchange into something that I want to convert, I have to keep it as 24 months as an investment property. I must hold it for a minimum of 5 years. So if I use the minimum requirement of a new exchange property, I have it as an investment for 24 months. I move into it for three years. I sell it at 5 years. So then I get a proration of the 121 tax code. And that would be, I'd get 60% because I've lived in it for 60% of my ownership, 3 of 5 years. So instead of instead of $500,000 in gain exclusion, I get 300 gain exclusion. And if I'm an individual, I get 150 instead of 250. So it's not a straight answer, yes or no. It depends on if it's been an investment from the beginning. I don't want to just have something I've had for 10 years and then move in it for 2, because then I'm going to get hardly any exclusion. It's best if I roll it in with the intention of converting it into an investment to a primary home. But if it was my primary home that I converted, if you're willing to move back into it for 2 years, then yes, I could get 100% exclusion on that. Hopefully that answered the question.
Do we have time for one more question? This one is about moving into new construction. So can you avoid the capital gains selling a home after 1 year living there to move into new construction?
No, it's still for the 121 tax code is my primary home. I have to live in it for 2 of the last 5 years. So 1 year is not going to do me any good. I have to live in it for 2 years.
All right, that's all the questions for now.
Okay. By the way, under the 121 tax code, the only exception to the 24-month rule on that, and you'd have to look it up. Always make sure you go to the IRS.gov website. You can look up the IRSC 121 tax code to look at it. Family farms can be exchanged, yes, and that would probably be a mixed use, honestly. And I don't have time to talk about mixed use, but you could use both tax codes in that particular situation if I lived there and it was investment. On the 121 tax code, if you or someone you know falls into a situation of either a health issue that forces them to sell their real estate or a job issue where they have to relocate for employment, they could qualify for a proration under the 121 tax code for either one of those hardships. So, but normally the case on the 121 is it's a minimum of 24 months. And I have known people with that question. I've known people that have moved into investment properties for 2 years and then sold and bought again and moved in it for 2 years and so on and so forth. So the 121 is not a one-time tax exclusion. So there are some investors that have done it that way. It just means you have a 2-year hold and then you can sell it under the 121 tax code with no tax liability. Not many people do that. They don't have the patience for it, but it is a way to do a longer flip, basically. To be fully tax deferred exchange, there's a few things the IRS want you to do, which we talked about. Equal or greater value, all the money back into it, and then you offset the difference with the equal or greater debt. So in this example, the person sells for $2 million. They have $1 million loan. They walk away with $1 million cash. They buy a replacement for 2.5, new loan 1.5, all the cash in, fully tax deferred exchange. Okay, you can do a trade day. I like to think of it as top down. So every dollar less in value and or cash back into the replacement property is taxable. So keep in mind, even if I buy a greater value, if I keep any of my money out, that money is taxable, and vice versa. I can put all my money back in, but if I buy at a lower value, the difference is taxable. So the first steps, do you want to sell your property? Basically, once you get an accepted offer, that's when you want to open a 1031 exchange. You're going to have opened up escrow, and then you look at basically, we just reach out to escrow, we get a copy of your purchase and sale, we get a copy of the title report, we draw up exchange documents, everything will go directly to your escrow team. And then we provide wiring instructions to escrow to provide the money to us, and then the funds come to us to hold for you in a segregated bank account. Don't buy from a relative. Related party issues is a whole nother topic. By the way, guys, I teach 3-hour classes. And in fact, my real estate broker is broken down into 2 3-hour classes. So you guys are getting into like 6 hours of education. So I wish I could answer everyone's questions. And maybe Daniel will want me to come back with some more complicated subjects. Typically the same thing. You get a purchase and sale agreement, get it under contract for your replacement property. You open title. Of course, we always recommend our sister company, First American Title, but we do work with all title and escrow companies across the United States. We will prepare documents and we'll provide those to escrow, and we will work with escrow to provide your money for your replacement property. So think about it as it is money that's held in a bank account that you simply don't have access to. That is how we provide you with what the IRS calls safe harbor, and that's really important when it comes to a 1031 exchange. They're pretty inexpensive, so you can figure $1,000 to $1,500 in that neighborhood to do a 1031 exchange. If I start doing more complicated exchanges like reverse and improvement exchanges, they're going to run probably in the neighborhood of $10,000 and more. But a typical forward exchange, you're going to figure, depending on your price point and where you're located, somewhere in that neighborhood of $1,000 to $1,500 on average. So part of what Corey is going to be talking about is this is an exit strategy that I like to have people know about, and that's Delaware Statutory Trust. Now, a lot of you probably haven't heard of a Delaware Statutory Trust, but I bet you've heard of a REIT, a real estate investment trust. You cannot exchange into a REIT, but you can exchange into a DST. In fact, they were specifically designed by the REIT sponsors with the IRS to have it available as something that people can exchange into. So the big boys like Inland Securities, Pasco, I think there's another company, went to the IRS and said, hey, we want to be able to design can exchange into, and they came up with DSTs. So Delaware Statutory Trust is a securitized product. You would buy it through someone, a reseller like Corey, and it is regulated by the SEC. It is, I like to think of it as kind of like an institutionalized purchase. It's a great exit strategy, or also a plan B, or maybe I have some cash and just don't know what to do with it. It's not enough to buy something else, and I really don't want to buy something else. The minimum buy-in, my understanding is typically $100,000. And I have a lot of people who just are done with being landlords, but they don't want to get hit with a bunch of taxes, and they don't know what they would do with the money, and they're used to the income off of those properties. A DST is a great option for these people. So it's great for diversification. I get to avoid management requirements because I'm not the one managing, it's professionally managed for me, or again, a small balance left over from a replacement property. Now, some disadvantages is you don't have control over that asset. And that's hard for some real estate investors because they're used to having that control over the asset. And then holding time. Holding time is somewhere between 7 to 10 years. So it's not a quick flip. I can't decide in 2 years, I don't want to be in it. But understand you will have a real good idea up front when they're expecting on divesting that portfolio and when the sales date is going to be. Now, sometimes might be longer, sometimes that might be shorter, but you're going to have a good idea going in when you're going to be able to do it. At that point, when they go to sell that asset, they'll advise you, you can choose to exchange into another DST. Or if you say, well, that's not fun, that was fun, not interested in that anymore, you can exchange back into a single owner asset. You with monthly dividends, so you get monthly money. You depreciation write-off on that as well, and it is inheritable, so you can pass to your heirs. It does get that step up in basis, just like you would on that. Fee structure is going to be on a case-by-case situation, and you'd have to talk to someone like Corey to go through fee structures. Understand the qualifications to invest. You do need to be an accredited investor. That means you either have $1 million net worth, excluding your primary home, or a an exclusion, or an income of 200 as an individual or 300 as a couple. And the RIA would go through qualifications with you before they go into their portfolios. One of the things that's nice is that you would get a full pro forma of those portfolios that are available before you decide what you're going to go into. One of the things that's nice about that, you don't have to be too worried about that 45-day rule because you're going to select your DST in advance, okay? Typically, basically they'll quote you on a case by case on the return on that investment, but I feel comfortable saying somewhere in the 5 to 6% return net. So after all expenses are incurred on that property, you are going to look at somewhere between 5 to 6% return. And yes, the depreciation is a benefit of the DST that is available to you as an investor into that DST. That is saying that if you had depreciation, if you just exchange bare land, you're not going to be, there's some schedule things with that they don't give you depreciation when you have a non-depreciable asset they are exchanging at. That I don't really get into. I don't get into that, but typically you're going to have depreciation write-off as well as that. And then when you go to sell, you're going to be selling hopefully at that new increased value and moving forward from there. It doesn't go up and down like that, like a stock market, because you're going to be invested in real estate. So you are exchanging in and you are taking a beneficial ownership interest into the real estate. So that's important. Some examples of DSTs would be adult care facility, medical facility, a storage facility, large Class A apartment complexes. Most of your assets are going to be in Arizona, Nevada, Texas, Florida, Tennessee, Indiana, places like that. You're rarely going to see them on the West Coast. Our numbers just don't work well for a good return on investment. Understand that the DST providers, the sponsors, have been doing REITs for 40 plus years. So even though DSTs have only been around since 2004, the companies that offer those DSTs that resell through people like Corey have been around doing REITs for many, many years. So they are really well, they're very organized. When you get a portfolio, a pro forma on a portfolio, be prepared. It's going to be 300 to 350 pages long. They're very extensive. You're going to have really good information on what's going on. And one of the things that for me, if I was looking in an uncertain time as far as when it comes to real estate and things getting, right now we have tenants not paying rent, but you still have expenses. In a DST, they're not going to reach their hand out and say, okay, I need a capital contribution, Daniel, because we needed this. It's all built into the expenses of the investment. And I'm not, just because maybe my income is down because the performance is down due to unseen circumstances, I'm still not going to end up paying a mortgage payment, interest, and taxes and insurance, even though my tenant's not paying me. So it offers a little bit more security in that regard. Now, I can't say it's not without risk because anything that's an investment is going to have a risk associated with it. So it's not risk-free. Okay, so key points to remember. You want to purchase like-kind property, which again, we talked about was real estate to real estate for investment purposes. I only have 45 days to figure out what I'm going to buy. I have 180 days to complete my exchange. I should purchase equal or greater in value, put all my money back in, and people should do their research when they're selecting a qualified intermediary to hire. And as far as First American Exchange, do understand we are probably one of the largest, if not the largest, company in the U.S. We do offer financial security. Exchange funds are guaranteed. Each account is set up in its own separate bank account. We do have fidelity bond, E&O, expertise, and reputation, and we are a full service company. Thank you. All right, Corey, let's let you have I'm gonna see if I can get out of this. Escape, okay.
And just so everyone's aware of the timeline, we do have 3 minutes left in the meeting.
Yes, sorry, I tried. And I wish I could answer more questions, but again, feel free to get my information from Daniel. You can pose your questions to me individually. I'm happy to answer any questions that you have that I was not able to address today. And Corey, was there anything specifically that we needed Corey to talk about?
Can you hear me? Can you hear me okay?
Yep.
All right. No, I think you summed up DSTs, so I don't have really anything to add other than the inventory is usually changing rapidly because when they come out with an offering saying they're trying to raise $30 million for the properties in any given DST, those usually funds are usually raised between 30 and 60 days, sometimes sooner. So it is, you may think about listing your property, and by the time you're actually time to identify a property, there might be a whole new inventory of what is available, which is going to change how much debt is in a DST. So if you're trying to sell your property as no debt, so you want to get an all cash DST, there's going to be certain limitations on what's available versus others might have 50% debt. And then there's ones that have very high debt that are more of a amortization depreciation type of effort. So those are going to be changing, just a heads up there. And then with the last 2 minutes, if there's any other random questions regarding that, feel free to type them out. And obviously, I have to say that with DSTs, they are an investment vehicle, so they are a very personal recommendation to any given individual. So if they are of interest in learning about, that will have to be an offline conversation. So I list my email in the chat box, so feel free to email me, and I'm happy to set that conversation up and see if it'd be appropriate or if it's something that I can get you more information on. And
I
just
think there was a good question asking about the syndication. That was a good question. The second to the last slide. Okay. Did you see that, the difference between a syndication and a
So
DST?
a couple. Here's the really quick answer. DSTs are created. It's a trust that's created by the real estate sponsor, so they have all control over decisions made and are the ones who are initially financing and putting capital to the deal. So it is completely hands off in terms of you obviously don't have any of the leverage obligations or tenants, toilets, and trash, and that also plays for your ability. There's no voting on matters, so you're kind of captive to the board of directors on that real estate company in that same way. So that's kind of the main idea, is your experience versus a syndication. And fee structure, we could talk about that. Just email me, please, about that.
All right, Melissa and Corey, thank you so much for coming and presenting to our club here at Intel. And I'll make sure that your contact information is made available on our SharePoint site. So thank you very much.
Thank you very much. We really appreciate it. And if you're interested in a follow-up with some more complicated exchange questions, I'm happy to schedule time for that.
Great, thank you.